Hello and welcome to Casper College. The following series of videos will give you an overview of Casper College's benefits package, including insurance, retirement, and employee leave. After you've watched all the videos, you'll be scheduled for a meeting with the benefits specialist to get you officially signed up for plans and answer any other questions you may have. Our insurance benefits are administered through EGI, Employees Group Insurance, through the state of Wyoming. Plans include health, dental, life, vision, ambulance, disability, and flex plans, and HSAs. Benefits are offered to full-time employees, and coverage begins on the first of the month following your date of hire. You must provide required documentation within 30 days of the application deadline. This includes things like birth certificates and marriage certificates to add dependents to your plans. You can request changes to your benefits during open enrollment each year, which is October 1st through November 30th. Changes made during open enrollment are effective January 1st. There are also certain situations that may allow you to make changes outside of open enrollment. These are called qualifying events and include things like marriage, divorce, birth or adoption of a child, and loss of other coverage. It's important to know that if you waive the health insurance offered to you through your employer, you will not be eligible for government subsidies through the Affordable Care Act. The basic benefits, those that the college will help you pay for, are health, dental, and basic life. The college contributes approximately 82% of the cost of your premiums for those three. It does not contribute toward premiums for voluntary plans, which we'll discuss later in the video. The amount of the contribution made to help you pay for basic benefits differs according to who you're covering on your plan. This assures that everyone has about 82% of their costs covered. If you have a spouse who works for another entity that uses the state plan and you're covering children, you'll be on what is called a split premium. If this applies to you, we'll discuss it in our in-person meeting. The health plan offers 4 deductibles you can choose from. The $900 deductible plan is displayed in the orange band at the top, followed by the $2,000 plan in the blue, then the $4,000 deductible plan in green, and finally the high deductible plans are in purple. These high deductible plans include 2 options, the $1,700 plan for employee only and the $3,400 deductible plan, which is for the employee and 1 or more family members. We'll go over each plan in the next few slides, but before that, let's examine how pricing works by reviewing the health and dental rates on this sheet. If you enroll in a health insurance plan, you must also take preventive dental coverage. Optional dental coverage, however, is entirely up to you. For now, we'll focus on the cost of the health insurance and preventive dental. To determine the total cost of a deductible plan, you will add the health insurance premium and the preventive dental premium together, and then subtract out the college's contribution, which is called full match on this sheet. And that will help you find your monthly cost. The lower the deductible, the higher the premium. For an employee covering just themselves, the cost of the $900 deductible would be around $186, while the cost of the $4,000 deductible plan would be about $23. We'll also look at this sheet on EGI's website, as well as their price calculators. If you decide to waive health insurance, you still need to meet with the benefits specialist officially to opt out of the plans. Also, as far as cost is concerned, please know that when you come in and meet, you'll be able to see your monthly price for everything and won't click submit until you're comfortable with what you'll be paying. And finally, don't forget to bring documentation for your dependents to your meeting. You may already be familiar with these health insurance terms, but just in case, the deductible is the amount you must pay for covered health care services before your insurance starts contributing its part. For example, if your deductible is the $900 deductible and you need surgery, you would cover the first $900, and after that, your insurance would pay 80% of your costs and you would pay 20%, which is your co-insurance, up until you reach what is called your out-of-pocket maximum, which for the $900 deductible plan is $2,900. That's the most you would have to pay in a plan year. Later, I'll show you how to access detailed summaries of each deductible that tells you the out-of-pocket maximum for each and more. A copay is a fixed amount that you pay for a covered service regardless of whether you've met your deductible. For example, if you visit your primary care doctor, you'll pay $35 even if you haven't reached your deductible. If you see a specialist like a cardiologist, the copay would be $55. And if you need to pick up a prescription, even on day one of your insurance being effective and you haven't met any of your deductible, the copay for a prescription would be about $10. We have both traditional plans here and high deductible health plans to choose from. All of these plans are preferred provider network plans, and your healthcare costs are lower when you are in the network. Be sure to ask your doctors if they are in network before scheduling appointments or procedures. Traditional plans cover a variety of things even if you haven't met your deductible, as we talked about before with the copay, such as prescriptions and office visits. It also would pay 100% of preventive care, whether you've met your deductible or not. Preventive care would be things like vaccines, mammograms, and colonoscopies. The high deductible health plans work a little bit differently, and you must have met your entire deductible on these plans in order to have things like prescriptions or appointments covered. And because of that, because less of your health care is being covered right away on those, they are eligible to have you open an HSA with those, and we'll talk about that more in a minute as well. As I mentioned, you can't take health insurance without also taking preventive dental. Those two are tied together. However, you can take the preventive dental and not take health insurance. Preventive dental covers exams, cleanings, and x-rays at 100% every 6 months. Optional dental is what would help you pay for actual dental work like root canals, extractions, crowns, all of those kinds of things. And that optional dental has a $50 deductible and a maximum benefit of $2,000 per person per year. Basic term life is also offered through the Standard Company. As you age, your premium increases and your benefit decreases. You can also elect dependent life to cover your spouse and eligible children. $1.46 covers all of your dependents with a $4,000 policy. On the next few slides, we'll talk about flex plans that allow you to set aside pre-tax money deducted directly from your paycheck to reimburse yourself for qualifying expenses. Flex medical accounts are available with traditional health plans and allow you to reimburse yourself with pre-tax money for medical expenses that qualify but which are not covered by your plan. These accounts are called use it or lose it accounts because you do forfeit any funds left in the account at the end of the year. So if, for example, you overestimated your medical expenses or you missed the final deadline to submit claims for the year, you will lose the money that's in your account. Flex daycare accounts allow you to set aside pre-tax money to reimburse yourself for dependent daycare expenses for children or dependent parents who qualify. And again, as with all of the plans discussed in this video, I will show you where to access the plan books on this for more details. Wraparound medical reimbursement plans are for people on the high deductible health plan. It can be used in addition to an HSA, but you don't have to have an HSA to have the wraparound. This account is mainly used for dental and vision costs since claims that are eligible under health insurance are not eligible for reimbursement under the wraparound. A health savings account is not a flexible benefit. You must be in the high deductible health plan to participate in this, and you do have to open it through your own financial institution. Money must be in the account for use, and elections can be changed at any time. You should know that EGI will cancel your deductions if at any time you change from the high deductible health plan to another plan. As I mentioned, an HSA is not a flex plan, so let's take a quick look at a comparison of the two. Both HSA and flex accounts give you pre-tax savings. Flex plans are tied to employment and HSAs are not. You can change your election of how much you want to have taken from your check in your HSA at any time, and with the flex account you can only do that at open enrollment. Flex accounts are administered through EGI, and HSAs are set up through your own financial institution. They each have their own maximum deposits for the year, and with an HSA your unused funds roll over at the end of the year, and with a flex account they are forfeited. With an FSA, the funds are available immediately, even if you have not had that deducted from your check yet. The entire amount you've taken out for the year would be available immediately, and in an HSA, funds are only available as they are actually deposited. Next, we'll talk about voluntary benefits, which are those the college does not make a contribution toward. If you elect these plans, although you get a good low group rate, you are paying the full cost. The first one we'll talk about is vision insurance through VSP. As with the optional dental and ambulance through MASA, there is a year lock-in and lock-out period. This means if you take the plan now, you must keep it for a year, and if you waive it, you cannot enroll for a year. Depending on your hire date, that could mean that you're actually locked in or out for 2 years, because open enrollment might fall just shy of your 1-year anniversary, in which case you'd have to wait for the next open enrollment period to drop or add one of these plans. There are 2 plans to choose from for vision. Plan B lets you get new frames or contacts every other year, while Plan C covers those expenses every year. The frame allowance for Plan B is $170 and for Plan C $190. This allowance might be applied instead to contacts if you choose. You'll also receive 20% off any costs above those amounts. VSP is the only one of the insurance plans offered that won't send you a card. The eye doctor will look you up by your Social Security number. So these are the prices for the 2 plans. As you can see, the price depends not only on the plan, but on how many people are covered. Optional dental is another plan with a lock-in and lock-out period of 1 year. This plan covers basic dental work like extractions, crowns, and root canals. There's no orthodontic work covered. And now voluntary life. If you have elected the basic life that we looked at earlier, then you can choose to add on voluntary life. You can't take out more on your spouse than on yourself. You can only elect the full amount offered at the time you're first eligible as a new employee, and coverage must be taken in $10,000 increments. The coverage for children is $2 regardless of the number of children covered. This is the price coverage or the coverage rates for an employee, and so you can see that it's done in age bands as well. An employee under age 40 could choose $10,000 of coverage for 73 cents, or if you look way down at the bottom, $250,000 would be $18.25 per month. Spouses can be covered with up to $50,000 and children with up to $10,000. The college will also pay for a life and long-term disability policy for you through the guardian. The life covers you with a $10,000 policy, and the long-term disability replaces 60% of lost wages after a 6-month waiting period in the case that you're disabled. EGI provides both short-term and long-term disability insurance options. However, as I mentioned, the college already covers a long-term disability policy for you. Since the only one of these long-term policies could pay out in the event of a claim, most employees choose not to purchase an additional long-term plan from EGI. However, you may consider purchasing their short-term disability insurance, as the college does not provide a short-term policy for you. A short-term plan helps bridge the gap between the onset of a disability and the 6-month waiting period before long-term disability benefits begin. Moss's ambulance plan covers ground and air transport and picks up costs after your health plan has paid or instead of your health plan in the case that it doesn't pay. The cost for this is $19 a month and covers you and all your dependents for that one cost. Everyone at Casper College must choose whether they want their insurance premiums to be deducted pre or post-tax from their pay. Pre-tax premiums reduce your taxable income. When you select this option, you cannot drop dependents without a qualifying event change. Most people at Casper College do choose pre-tax premiums.